Happy Monday, everyone. Welcome back to a new episode of Capital Markets Quickie. I'm your host, Andrit Sella. Today, we're diving into the world of oil. So let's get right to it. Oil prices are gearing up to touch the $100 mark per barrel this month, marking a first for 2023. There's been a hefty rise of almost 30% since June in Brent crude oil. So what's behind this? Production cuts from Russia and Saudi Arabia, and a surge in demand from China. Those are the three things that are driving oil prices as of now. But let's talk specifics. Brent crude, a significant oil price indicator, peaked at nearly $94 a barrel last week. If you cast your minds back to June, it was only at $72. This surge is the largest we've seen since Russia made headlines with its invasion of Ukraine. The US variety called West Texas Intermediate, or WTI, hasn't been left behind either, guys. Its price rose from $67 a barrel in June to $90 just last week. For our US listeners out there, I'm pretty sure you've seen it yourselves. Gasoline prices have shot up more than 10%, now sitting at $3.90 a gallon on average. But it doesn't stop there. Let's talk about the frequent flyers, because jet fuel prices have also taken off by a whopping 50% since May. Wow. Earlier this month, Saudi Arabia extended its 1.3 million barrels per day of combined cuts to the end of the year, accelerating a drawdown in global inventories. Supply cuts by Russia to boost prices have also supported efforts by other OPEC countries to push prices towards $100 a barrel. So it seems like it's the race to $100 a barrel. Now, here's a little warning from the International Energy Agency saying that this combined supply cut strategy by major OPEC Plus leaders could lead to substantial market volatility. In fact, they've said that there's a looming deficit of over 3 million barrels per day for the next quarter, which might lead to the biggest supply crunch we've seen in over a decade. And one more thing to note, OPEC is also very worried. Now, why, you're asking? Well, predictions are that the demand for oil might peak before 2030, with some even speculating it could happen as early as 2026. And this is all due to the efforts to switch from oil as a main source of energy to more sustainable energy sources. However, for the time being, this move away from oil, the rising fuel costs combined with high demand from China, which is a major oil consumer, well, these might be a headache for central banks aiming to tame inflation rates. And speaking of central banks, the European Central Bank recently marked its 10th consecutive interest rate hike, but they might not be done just yet. Similarly, in the US, even after a recent decline in core inflation, the Federal Reserve hasn't closed the door on another potential rate hike in November. But we'll hear more from the Fed this Wednesday at their next Fed meeting. And that's your quickie for today. See you on the next episode, which just so happens to be tomorrow. Have a great week, everyone. Cheerio.